The current market seems to hate tech, and why not? Tech companies have been pumped up the last couple of years because of a sudden jump in technology demand and the resulting chip shortage. Russian manufacturers to increase facilities and production to a point where it all seems to be turning cyclical. Add on the increased rates and fears of inflation, and you have a catalyst for correction, much like we've been currently seeing. I previously covered Qualcomm, and being a tech company, it's taken a hit much like the rest. So here's an update on my position and what actions I'm currently taking. If you want to learn more about the yield curve and the current risk of inflation, check out my recent video where I covered this subject. I said at the time that I wasn't giving up on the market. Volatility in the market comes and goes, and I tend not to overthink it. The last 2 years have seen companies pumped up to extraordinary highs, trading at ridiculous fundamentals thanks to excessive media attention creating too much positive investor sentiment. The problem with stocks trading on sentiment and not fundamentals is that tide is eventually going to go out, and to quote Buffett, it's only then that you're going to see who's swimming naked. Now investors are questioning why they bought unprofitable companies and tech giants trading at such high multiples. With semiconductor production pushed to meet demand, the industry is looking cyclical, and eventually with all production facilities available to meet demand, most of these tech companies are going to peak and set themselves up for a correction. However, if you've been following my channel, you know I hate pumped up companies, and they are a huge turnoff for me. I prefer to invest in smaller companies with great potential for growth or a unique selling point. By avoiding Tesla, AMD and Nvidia, I've avoided the recent corrections. Plus, I've had a great time shorting Cathie Wood's ARK Innovation Fund. Despite reaching a high of $108 in January, Qualcomm has been receiving some punishment over the last couple of months, with the stock falling 25% year to date. I covered the company because it happens to be one of the few tech companies in my portfolio, the other being a speculative play in solid power. The link is below if you want to check out my deep dive. Otherwise, here's an update on Qualcomm's latest report and why I'm still bullish. In the latest quarter earnings report, Intel stated that demand for computers is weakening, which seems to have had a detrimental impact on Nvidia, AMD, Texas Instruments, Broadcom and Qualcomm stocks. But I think investors have underestimated Qualcomm, who thanks to their patented technologies are instrumental in the 5G, Wi-Fi and Bluetooth markets. On top of that, they are making considerable efforts to diversify their business lines by expanding further into hardware technologies. They make a significant contribution to the hardware in 75% of Samsung's flagship device platforms, such as the S22 and Galaxy Tab S8 series, which uses Qualcomm's Snapdragon 8 chip. They are also highly present in Chinese products, namely Xiaomi, Vivo, Oppo and Honor. This success brings more recognition to Qualcomm as a serious contender in the smartphone industry, and likely to extend their influence in the industry further, especially when it comes to Android operating systems, which currently represent over 70% of smartphones. Their advancement in the hardware is important, as Qualcomm and Apple's 2019 legal battle resulted in a 6-year patent licensing agreement, but gave Apple an incentive to pursue Intel's smartphone division through a $1 billion deal. Apple's focus was on acquiring the 17,000 wireless patents that would allow them to lessen their reliance on Qualcomm and develop their own in-house 5G chips for their iPhones. These are expected to launch in 2023 and are expected to cut Qualcomm's supply of Apple chips to just 20%. So Qualcomm is fighting back, and having spent $1.4 billion purchasing Nuvia in January 2021, that's a chip startup company founded by ex-Apple chip designers, they have the goal of introducing a revolutionary new ARM-based processor by late 2023, taking on Apple's M-series processors head-on. Watching these two companies fight it out and trade blows is going to be interesting. In addition, the company finalised their acquisition of Arriva, which is paving the way for further advancement with their driver assistant technologies in the motor trade. The company has reached a multi-year agreement with Stellantis, the 4th largest auto manufacturer in the world, which covers brands such as Fiat, Jeep, Peugeot and Vauxhall. Qualcomm will incorporate their scalable automotive platforms into those vehicles, such as over-the-air updates, AI interfaces, as well as diagnostic and repair features. There's also the joint venture with BMW to develop their automated ride platform using Qualcomm's Snapdragon digital chassis system on a chip ride technologies. And Volkswagen have announced they will be implementing that technology across all their brands, starting from 2026, a deal worth $1 billion. Which is just a portion of the automotive pipeline that Qualcomm estimate to be worth up to $16 billion. But as always, here are the financials. So starting with their latest earnings report, Qualcomm beat analyst expectations with earnings per share of $3.21 compared to $2.91 expected. Adjusted to $2.57, this represents a 69% year-on-year growth and still ahead of the major chip manufacturers. Revenue continues to climb, and the last quarter was up 41% to over $11 billion. They remain clearly ahead, hitting $39 billion on a trailing 2-month basis. The latest quarter represents a 58.4% profit margin as they continue to outpace the competition. With their technology division, QCT, there was a general upwards trend across all segments, including the handset technologies up by 56% year-on-year, internet technologies up by 61%, automotive technologies up by 41%, and total QCT revenue is up by 52% to $9.5 billion. Qualcomm's unique selling point is their RF front end, which represents their patented communication technology that is essential for 5G connections, and that section has grown by 28% to $1.16 billion. The only slip was Qualcomm's licensing, QTL, which is down by 2% to $1.58 billion, but that still beat analysts' expectations of $1.55 billion. The company reported $951 million of share buybacks and $764 million in cash dividends, which they just increased from 68 to 75 cents. That continues their trend of increased dividend payments. With Qualcomm trading at around $140, that's a yield of 2.15% and leagues above the competition, and great news for investors who love a dividend. Qualcomm have a positive outlook for the future and expect to hit a earnings per share of $2.75 to $2.95 based on an average $10.9 billion in sales, which is a compound annual growth rate of 13.26%. They expect their technology licensing division to continue to bring in increased revenues and estimate $1.4 to $1.6 billion. When the earnings were declared on the 20th of April, the stock jumped $135 to $148, but this has since come down. At $140, Qualcomm trades at a forward PE of 11.42 and a PEG ratio of 0.72. And that makes them very attractive compared to their competitors, especially when you compare the dividend yield. So, Qualcomm is a buy. Compared to the companies who have been missing expectations, Qualcomm is defying their critics by delivering high revenues, paying off debt, raising cash, increasing shareholder equity, and topping this off with share buybacks and a rising dividend that is leagues ahead of the competition. A huge advantage to any company is a unique selling point, and Qualcomm is no exception. But by being seen as a communications technology company, they have been vastly overlooked. This also means they weren't hyped up as much as major chip manufacturers, and as they continue to expand their business into computer and auto chip technology, they are becoming a serious contender in a cloud-connected, metaverse-hyped market, whilst trading low enough to still offer value to investors. Still, disappointment seems to be the theme of the month, given how badly the Nasdaq has performed. It's almost as disappointing as the predictable and lazily written second season of Picard.
All hands abandon! All hands out. Transfer emergency power to the antimatter.
But that's to be expected with a market overinflated with sentiment. At Qualcomm's current levels, I'm not going to fuss over sentiment whilst it continues to trade at such a discount. Holding out for the stock to fall further seems complacent and likely to result in missing out on the bounce, and given the green numbers this week so far, I think that's where we're at. Qualcomm checks all the boxes, so I'm in. So that's my take, but if you have any thoughts, please comment below, let me know. And if you like what you see and you want to see more, don't forget to smash that like button and subscribe so you don't miss out on future videos. Until next time.